For decades, two words defined the modern computer: Intel, Inside. In the 1990s and 2000s, Intel was untouchable, powering everything from office PCs to NASA supercomputers. Its chips ran the digital revolution, and its profits soared past $20 billion a year. But then something changed. The world moved on. Apple switched to its own silicon chips, and Nvidia took over the AI world. But an unexpected partnership made the stock surge over 20% in just one day. Is it now the time to buy? This is the fall and rise of Intel. Chapter 1. The unexpected partnership that revived Intel. A month ago in September, Nvidia and Intel announced that they had a massive collaboration. Nvidia is now the global AI leader, and its market cap is over $4 trillion, and it's the biggest company in the world right now. And it's investing in Intel, which is great for Intel because Intel was a losing business. And they invest $5 billion to co-develop multiple generations of AI data center and PC chips. So the implications are significant, especially for Intel. The deal represents a much needed endorsement at a critical moment in its turnaround. We're now looking at Intel. We're looking at the charts on TradingView, and we can see it's now trading at $37. Year to date, it's up 84.7%, which is great. Collaboration between Nvidia and Intel was announced here, and that's why this massive gap up of more than 25%. So Intel was struggling financially, but now Nvidia is a partner and an investor. It's like Nvidia is now holding the hand of Intel. This financial buffer gives Intel the opportunity to turn around. Chapter 2. Is Intel a great investment? Let's do a deep dive stock analysis right now. Let's first figure out whether Intel has a strong economic moat. An economic moat refers to the competitive advantage that a business has to protect itself from competitors. So here we can use the economic moat analyzer and we can press Intel. Here we can see that it has a narrow moat, which means that it's not too strong, the economic moat. And the moat consists of the intangible assets, switching costs, network effect, cost advantage, and efficient skills. And here can you see the strength and the risks. So based on the economic moat, I would say that this investment is a little bit risky because it doesn't have a wide moat yet. We are now looking on Guru Focus to get a quick financial overview of the company. So this is one of the biggest weaknesses of Intel. We can see that the financial strength is 5 out of 10 because the debt levels are not great. And if we look here lower, cash to debt ratio, you see they have more debt than cash. And you can also see here that the revenue has dropped in the last few years. Now we're going to figure out whether Intel is cheap or expensive. If this company is undervalued, it can still be a great investment. Intel is now a turnaround company. The earnings right now are negative, and that's why we're going to use a price to sales ratio to find out whether it's cheap or expensive. So the price to sales ratio formula is the market cap divided by its revenue. And this tells you how much investors are paying per dollar of sales. So here on TradingView or many other websites, you can find the market capitalization, which is 174.15 billion. And if we go to statements, and here on the income statement, we can see the total revenue. And we always look at TTM, which is the last 12 months. So the last year, and it's $53.07 billion. Now we have the numbers. So let's fill in the formula, market cap divided by revenue. So 174.15 billion divided by 53.07 billion is 3.28. So the price to sales ratio of Intel is 3.28. So is a price to sales ratio of 3.28 expensive or cheap? So in this table, we can see Intel versus its competitors. So here's Intel above, and we can see that the price to sales ratio is 3.28. And if we look at AMD, it's 11.96. Nvidia also much higher, so more expensive. TSM much higher. Qualcomm is also pretty low, like Intel, but Intel still lower. And then Broadcom is a lot higher. So if we compare it to the competition, we can see that based on price to sales ratio, Intel is actually very inexpensive right now. Should you buy or should you sell? Let's find out in this final chapter. The partnership with Nvidia has breathed new life into Intel, not just with a $5 billion boost, but with renewed relevance in the AI era. The stock's momentum has turned bullish, yet beneath the hype lies a fragile base. A narrow moat and weak financials make the comeback uncertain. Still, with one of the lowest price-to-sales ratios in big tech, Intel looks cheap, maybe too cheap to ignore. We're now looking at the charts of Intel. We're looking at the daily candles and it's now trading at $36. We can see that a few weeks ago there was a golden cross, so right now the 50 EMA is above the 200 EMA, which is a bullish signal, and since the announcement the stock has only gone up. If we look at weekly candles, we can see that it's now trading above the 200 EMA, which is also bullish. I personally own like a 4% position in Intel, so I have a small position in Intel, but I'm willing to buy more once it retraces back to the 50 EMA, like $30 or $25. This is a good portfolio example. Always remember not to over allocate in a stock, even if you're really sure. So I personally only invest like 4% into Intel, but I will buy a little bit more if it drops like to $30 or $25. And I'm very bullish on the semiconductor industry. I also own Nvidia and SMCI, for example. So I think Intel is a great stock to have in your portfolio. It can turn around, it can be a defensive play, and I think it is a great company overall. But always remember to manage your portfolio well, keep your cash reserve, and always do your own due diligence. I hope you learned something, I hope you enjoyed this video, and don't forget to like and subscribe, and I'll see you in the next video.